All right, welcome back to Everyday English Pod, everybody. Glad to have you here as always. Today we're going to be talking about money, and I'm really excited about this one. It's something that impacts everyone's life, but sometimes the language surrounding money, especially here in America, can feel, well, a bit overwhelming. We throw around terms like interest rates, mortgages, investments, and honestly, it's easy to get lost in the jargon.
Oh, absolutely. And understanding these terms is so crucial for making informed decisions about our finances, whether it's managing our everyday spending, saving for the future, or even just understanding the news.
Exactly. So we've gone through a whole bunch of resources, explanations, real-world examples, the works, to break down some of the most fundamental financial terms you're likely to encounter in American English. By the end of this, hopefully, you'll have a much clearer picture of how these concepts actually work and how they apply to your own life.
Sounds like a plan. So where do we start? Back to the basics.
Let's do it. Let's start with the very foundation. What is money?
Well, in the simplest terms, money is anything that's widely accepted as payment for goods and services. It's what we use to exchange value. I mean, think about it. That $20 bill in your wallet, the digital dollars you use online, that's all money doing its job.
Okay, that makes sense. So when we talk about cash, we're specifically talking about physical money, the actual bills and coins.
You got it. That's cash, the tangible stuff. And then there's currency, which is a slightly broader term. Currency refers to a country's official system of money. So here in the U.S., our currency is the U.S. dollar, but other countries have their own, like the euro in Europe or the yen in Japan.
So currency is like the overall system, and cash is the physical representation of that system.
Precisely. And all this money, whether it's cash or digital, we usually keep it in an account at a bank.
Right, accounts and banks. Those are terms we hear all the time. Can we break those down a bit more?
Sure. So think of a bank account, like a digital record that keeps track of all your money. It's where you deposit your paychecks, make withdrawals, and even earn a little something called interest, depending on the type of account.
And a bank is the institution that manages these accounts. They keep your money safe, lend it out to people and businesses, and help us process payments. We have big national banks, smaller local banks, and even credit unions, which are member-owned financial cooperatives.
Right. They all play a crucial role in our financial system.
So we've got money, cash, currency accounts, and banks, all essential building blocks. But now, how do we actually manage all this money effectively? Where does the concept of a budget come in?
Well, a budget is basically a plan for how you're going to spend your money. It's a way to track your income, the money you earn, and allocate it to different expenses like rent, food, transportation, and hopefully some savings.
So it's about being intentional with your money, making sure you're not spending more than you earn, and that you're putting some aside for future goals.
Absolutely. It's like creating a roadmap for your finances. And then there's the difference between cost and price.
Ooh, yes. Those two often get confused. What's the distinction there?
So cost is the total amount of money it takes to actually make or acquire something. Think about a simple wooden chair. The cost would include the price of the wood, the glue, the labor to assemble it, even the electricity used in the workshop.
Okay, so cost is all the expenses involved in production.
Right. And then price is what you actually pay for that chair in the store. The store needs to set a price that's higher than the cost to make a profit.
Ah, so price is what the consumer sees, and cost is more behind the scenes from the producer's perspective.
Exactly. And of course, once we have some money, we have two basic options. We can spend it or save it.
I think everyone's pretty familiar with spending. That's just using your money to buy things, groceries, clothes, that new gadget you've had your eye on.
Right. But saving is equally important. That's setting money aside for future needs, like a down payment on a house, retirement, or even just an emergency fund for unexpected expenses.
It's about delaying gratification now for greater financial security later on.
Exactly. Now let's talk about earning and paying.
Okay, so earning is pretty straightforward. It's receiving money for your work or investments, your salary, hourly wages, income from freelancing, or even profits from selling stocks. That's all considered earning.
Right. And paying, of course, is the other side of the coin. It's giving money in exchange for goods or services, paying your rent, buying groceries, or even settling that dreaded credit card bill. That's all paying.
And often before you pay, you receive a bill, which is just a formal request for payment.
Yeah, those pesky bills, your utility bill, your phone bill, your medical bill, they all tell you how much you owe for specific services.
Now, sometimes we don't have enough money on hand to cover everything we need, which leads us to debt and loans.
Right. Debt is simply the total amount of money you owe to someone else.
And often that debt comes from taking out a loan, which is when you borrow money from a lender like a bank and agree to pay it back over time, usually with interest.
Exactly. Common examples of loans in America are car loans, home loans, also known as mortgages, student loans, and small business loans.
And these loan agreements can get pretty complex, right? They often involve things like interest rates, repayment schedules, and even collateral.
Oh, absolutely. A loan agreement is a legally binding document that lays out all the details of the loan. The interest rate is the cost of borrowing the money, expressed as a percentage of the loan amount. So if you have a $10,000 loan with a 5% interest rate, you'll be paying an extra $500 in interest per year.
Ouch. So interest can really add up. And what about repayment schedules?
A repayment schedule outlines how much you'll pay back each month and over how many years. It breaks down the loan into manageable chunks.
And collateral is something you pledge to the lender as security for the loan.
Right. It's an asset like your house or your car that the lender can take possession of if you fail to repay the loan.
So it's a way for the lender to minimize their risk. And speaking of interest, it can be a double-edged sword, right? It's the cost of borrowing money, but it can also be something you earn on your savings.
Exactly. Think of it as the price of money. When you borrow money, you pay interest to the lender. But when you save money in a bank account, the bank pays you interest for letting them use your funds.
Okay, so interest can work for you or against you, depending on whether you're borrowing or saving.
Precisely. Now let's switch gears a bit and talk about the everyday flow of money, income, and expenses.
Okay, so income is any money you receive regularly, whether it's from your job, investments, or other sources.
Right. Think about a freelance web developer. Their income comes from the fees they charge clients for building websites. And then, of course, we have expenses, which is the money you spend to cover your needs and wants.
Like rent, groceries, transportation, entertainment, and those occasional impulse buys. And the difference between income and expenses is where profit and loss come into play.
Absolutely. If your income is higher than your expenses, you have a profit. That's money you've made.
And if your expenses exceed your income, that's a loss.
Exactly. Businesses aim for profit while individuals need to manage their budgets to avoid losses.
Now let's get into the nitty-gritty of managing our money in bank accounts, deposits, withdrawals, balances, transactions, and fees.
Right. Those are the day-to-day actions we take with our money.
So when you put money into your account, that's a deposit.
And when you take money out, that's a withdrawal.
The amount of money currently in your account is your balance.
And anytime money moves in or out of your account, whether it's a purchase, a bill payment, or a transfer, that's a transaction.
And of course, banks love to charge us fees for various services.
Oh, yes. Those pesky fees. ATM fees, monthly maintenance fees, overdraft fees, they can really add up if you're not careful.
So it pays to be aware of those fees and try to minimize them whenever possible. Now, let's talk about the different ways we pay for things here in America, from good old-fashioned cash to increasingly popular digital methods.
Okay, so we've got the ATM, the automated teller machine. That's your go-to for withdrawing cash quickly.
Then there are credit cards, which let you borrow money to make purchases and pay it back later, often with interest.
And debit cards, which deduct the money directly from your checking account.
Some people still use checks, written orders, instructing your bank to pay someone a specific amount.
And then there are transfers, where you electronically move money between your own accounts or send money to someone else.
So many options. Let's imagine a scenario, say, someone needs to pay their rent and also move some money between their accounts.
Okay, so they could start by using the ATM to withdraw some cash for smaller expenses.
Then, using their bank's mobile app, they could transfer money from their savings to their checking to cover the rent check.
And if their landlord still prefers paper checks, they would write a check for the rent amount.
Perfect example of using different payment methods in action. And speaking of convenience, online banking has become a game changer here in America.
Oh, absolutely. You can manage almost all your banking needs online, checking your balance, reviewing transactions, paying bills, even applying for loans.
That's so much easier than physically going to the bank. Now, we keep mentioning bank accounts, but there are different types with different purposes, right?
Right. The most common ones are checking accounts and savings accounts.
Checking accounts are for your everyday transactions, deposits, withdrawals, bill payments, and they're usually linked to your debit card.
And savings accounts are for money you want to set aside and hopefully earn a little interest on.
There are also money market accounts that offer higher interest rates but might have restrictions.
And certificates of deposit, or CDs, where you lock your money in for a fixed term to earn a higher interest rate.
A lot of options to choose from, depending on your needs and goals. Now, let's clarify what a bank statement is.
Sure. A bank statement is a record of all the transactions in your account over a specific period.
It shows all your deposits, withdrawals, payments, fees, interest, earned everything.
Right. It's like a financial snapshot of your account.
Really useful for tracking your spending and budgeting. And one more term I want to address is overdraft.
Ah, yes. Overdraft is when you spend more money than you have in your checking account.
And banks love to slap you with hefty overdraft fees for that.
They sure do. But luckily, there's overdraft protection, which can link your checking account to another account to cover those shortages.
So that can save you a lot of money in fees. Now, let's move on to the world of investing, starting with some basic investments that people often hear about.
Okay, so we've got stocks, which represent ownership in a publicly traded company.
Bonds, which are essentially loans you make to governments or corporations in exchange for interest payments.
Mutual funds, which are professionally managed baskets of different stocks, bonds, or other assets.
And real estate, which is investing in property like houses or land.
Right. It's important to remember that all investments involve some level of risk, and there are no guarantees.
But with careful research and planning, investing can be a powerful tool for building wealth over time.
Definitely. But it's crucial to understand what it means to invest and the various terms associated with it.
So what does it really mean to invest?
Well, investing is about putting your money into assets with the expectation that those assets will grow in value over time and generate a return or a profit.
And a stock, or share, as we mentioned, is a piece of ownership in a company.
Right. When you buy stock, you become a shareholder in that company and might be entitled to dividends, which are a portion of the company's profits that are paid out to shareholders.
And if the value of the company's stock goes up, you could potentially make a capital gain if you decide to sell those shares.
That's right. An investment can refer to the entire process of carefully selecting assets to achieve specific financial goals.
It's not just about picking random stocks, it's about creating a well-thought-out strategy.
Exactly. And the return on an investment is simply the profit or loss you make over a certain period.
Now, how do we bring all these individual financial concepts together into a coherent plan? That's where financial planning comes in.
Right. Financial planning is the ongoing process of managing all aspects of your finances to reach your goals. Budgeting, investing, saving, the works.
It's about creating a roadmap for your financial future, whether you're saving for a house, retirement, or just trying to manage your day-to-day expenses.
And budgeting is a fundamental part of that plan. It's about tracking your income and expenses to make sure you're staying on track.
Right. Even if you're not a financial expert, having a budget can make a huge difference in your financial well-being.
Absolutely. It gives you control over your money.
Now, let's say someone is ready to start investing, but needs some guidance. They might decide to seek out a financial advisor.
A financial advisor is a professional who can help you create a personalized financial plan based on your goals, risk tolerance, and time horizon.
They can help you choose the right investments, manage your portfolio, and even plan for retirement.
Exactly. It's like having a personal financial coach in your corner.
Now, building a secure financial future goes beyond just investing. It also involves being proactive with your savings and ensuring you have adequate insurance coverage.
Absolutely. Having a savings account is essential. That's where you keep money that you're not using immediately, and it usually earns a small amount of interest.
And when it comes to buying a home, most people in America need to get a mortgage.
Right. A mortgage is a loan specifically for purchasing a property, and the property itself serves as collateral for the loan.
So if you don't make your payments, the lender could take your home.
Exactly. It's a big responsibility, but owning a home can be a significant part of building wealth over time. And then there's insurance.
Insurance is a way to protect yourself from financial loss in case of unexpected events.
Right. There's car insurance, health insurance, homeowners insurance, all designed to cover costs associated with accidents, illness, or property damage.
It's essential for peace of mind and financial security. Now, to manage our finances effectively, it's crucial to understand our income, the money we earn.
Right. And two common ways people earn money in America are through a salary or a wage.
A salary is a fixed amount you're paid, usually annually or monthly.
It's common in professional jobs, like a software engineer or a doctor.
And a wage is typically paid on an hourly or daily basis.
More common in hourly jobs like retail or construction.
And of course, a portion of our earnings goes to the government in the form of taxes.
Right. Taxes are mandatory payments that fund public services like roads, schools, and healthcare.
When you get your paycheck, you'll see deductions for taxes as well as other things.
Exactly. And the person who receives the paycheck is the employee, and the company they work for is the employer.
Now, another important term to understand is affordability.
Yeah, affordability is about having enough money to comfortably pay for something without causing financial strain.
It's about making smart choices based on your income and expenses.
Exactly. It's not just about whether you can technically make the payments. It's about whether it fits within your overall financial picture.
Now, let's imagine someone has some questions about their first paycheck and the deductions for taxes.
Okay, so they might go to their HR representative, the person in charge of human resources at their company, for clarification.
The HR representative would explain the different types of taxes being withheld: federal, state, Social Security, Medicare.
Right. They'd also differentiate between a wage, which is hourly pay, and a salary, which is a fixed amount.
And they might even advise the employee to create a budget to track their spending and determine if they can afford certain purchases.
Great example of navigating those early career financial questions. Now, moving on to the broader world of buying and selling, let's talk about affordability in the context of making purchases.
Right. So before buying anything, especially a big ticket item like a car or a house, you need to consider if you can truly afford it.
Exactly. It's not just about having enough money in your account right now. It's about whether you can comfortably make the payments over time without jeopardizing your financial stability.
And then there's the concept of value.
Value is the worth of something, which can be monetary, like the market price of a car, or more subjective, like the sentimental value of a family heirloom.
And often we're looking for a good deal, a discount, which is a reduction in the price of something.
Those discounts can be tempting. Now, when we're talking about buying and selling, it's helpful to distinguish between retail and wholesale.
Retail is when businesses sell goods or services directly to individual consumers, like at a clothing store or a restaurant.
And wholesale is when businesses sell goods in bulk to other businesses, often at lower prices.
Like a distributor selling boxes of cereal to a grocery store.
Exactly. And the place where all this buying and selling happens is called a market, which can be a physical location like a farmer's market or a virtual platform like Amazon.
Right. So many different ways to connect buyers and sellers. Let's walk through a hypothetical transaction. Say someone's buying a new couch.
Okay, so the person making the purchase might be looking for a good deal on a couch.
The salesperson might highlight the value of the couch based on its quality and features.
If the customer asks about discounts, the salesperson might mention a sale they're having.
The customer would then consider if they can afford the discounted price.
And the salesperson might explain that their business is a retail operation, meaning they sell directly to consumers.
They might even mention that they also have an online market where the customer can browse and purchase items virtually.
A good example of how all those terms play out in a real-world scenario. Now, when a transaction takes place, that exchange of goods or services for money, it's important to understand the associated documentation.
Right. After a purchase, the customer typically receives a receipt as proof of payment.
And if you're paying for services, like from a freelancer or contractor, you'll likely receive an invoice, which is a formal request for payment.
Anything related to money or finance is considered financial.
So a company's annual budget is a financial document, a personal loan is a financial product, and managing your investments is a financial activity.
And when it comes to international transactions or travel, you often need to deal with currency exchange.
Right. That's the process of converting one country's currency into another.
Like exchanging US dollars for euros when you're traveling in Europe.
Exactly. So imagine a tourist from America visiting Europe.
They go to a currency exchange booth to get some euros.
They'll receive a receipt for the exchange, and their hotel might send them an invoice for their stay.
And throughout their trip, they'll be mindful of the financial aspects, making sure they don't overspend and budgeting for souvenirs.
Makes sense. Now, going beyond personal finance, let's touch upon some terms related to global finance and investments.
Okay, so we mentioned currency exchange, for individuals, but it also plays a huge role in international trade.
Absolutely. Businesses constantly need to exchange currencies to buy and sell goods across borders.
And a fund is a pool of money set aside for a specific purpose, like a scholarship fund or a retirement fund.
Right. Transaction fees are charges you might encounter for certain financial transactions, like sending money internationally or using a credit card.
Your credit score is a number that represents your creditworthiness, how likely you are to repay debts.
Lenders use your credit score to decide whether to approve loans and what interest rates to offer you.
If you need expert guidance on managing your money, you might seek financial advice from a professional.
And a financial crisis is a major disruption in the financial system, like the 2008 crisis, which can have widespread economic consequences.
Let's imagine an investor who's looking to diversify their portfolio by investing in international companies.
Okay, so they would definitely be dealing with currency exchange as they convert their US dollars into foreign currencies.
They'd be mindful of any transaction fees associated with those trades.
They might also consult with a financial advisor for guidance on navigating those international markets.
The advisor might even bring up the importance of maintaining a good credit score for overall financial health.
And they might touch on the potential for future financial crises and how to manage risk in those situations.
Really good points. Now let's dive into some key financial concepts from a business perspective.
Okay, so a company's assets are things of value that they own, like buildings, equipment, or even patents.
And their liabilities are their debts or obligations to others, like loans or unpaid bills.
Equity is the owner's stake in the business.
Yeah.
It's the value of the assets minus the liabilities.
Revenue is the total income a company generates from its business activities.
And a forecast is a prediction of future financial performance, like how much revenue they expect to earn next year.
Let's imagine a business owner meeting with their accountant.
Okay, so the accountant might point out that the company's inventory and equipment are considered assets.
And any outstanding loans they have are liabilities.
They would discuss the owner's equity in the business.
They would review the company's revenue for the past year.
And they might even help the owner create a forecast for the coming year to guide their financial decisions.
Now let's talk about some crucial terms related to investing and borrowing, starting with rate.
Rate is used to express a measure of one quantity against another, often as a percentage.
So you have interest rates, exchange rates, rates of return, all expressing a relationship between two things.
Capital refers to financial assets, like money that can be used to generate income or start a business.
A broker is an intermediary who helps facilitate financial transactions like buying or selling stocks.
An investor's portfolio is the collection of different investments they hold.
And a dividend is a portion of a company's profits that is paid out to its shareholders.
Right. So imagine an investor discussing their portfolio with their financial advisor.
They might talk about the rate of return they're hoping to achieve on their investments.
They might discuss whether to use a broker to execute their trades.
And they might consider which companies are likely to pay consistent dividends.
All important factors in making investment decisions.
Now, unfortunately, sometimes businesses and individuals face serious financial difficulties.
Right. In extreme cases, a business or individual might have to declare bankruptcy, which is a legal process for dealing with overwhelming debt.
An audit is an official inspection of a company's financial records to ensure accuracy and compliance.
Commerce refers to the broad activities of buying and selling goods and services.
A consumer is someone who buys goods or services for personal use.
And a contract is a legally binding agreement between two or more parties.
Let's imagine a business owner facing financial challenges who's seeking legal advice.
Okay, so they might be consulting with a lawyer to explore their options, including potentially filing for bankruptcy.
The lawyer might advise them to get an audit to ensure their financial records are in order.
They might discuss how e-commerce, buying and selling online, fits into their overall commerce strategy.
They might also emphasize the importance of having clear contracts with their suppliers and customers to protect their interests.
Really crucial advice for navigating those tough situations.
All right, let's cover a few more important terms.
Okay, so a down payment is an upfront payment you make when you buy something on credit, like a house or a car.
The exchange rate, as we discussed, is the value of one currency in relation to another.
Fiscal matters relate to government revenue and spending, like taxes and budgets.
A grant is a sum of money given by a government or organization that doesn't have to be repaid.
And inflation is a general increase in prices over time, which reduces the purchasing power of money.
So let's say someone is meeting with a banker to discuss getting a mortgage.
Okay, the banker would definitely explain the down payment required for the mortgage.
They might also briefly mention how exchange rates work, especially if the buyer mentions plans to travel internationally.
They might touch upon the government's current fiscal policies and how they might be impacting interest rates.
And they could also mention any potential grants available to first-time homebuyers.
A good overview of those mortgage-related terms.
Now, a few more. A merchant is someone who buys and sells goods, often in large quantities.
A premium is the amount you pay for insurance coverage.
A recession is a period of economic decline.
And a subsidy is financial assistance provided by the government to support certain industries or activities.
So let's imagine an entrepreneur who owns a small retail business.
Okay, they might be worried about a potential recession and how it could impact their business.
They might be looking for ways to reduce their insurance premiums to save money.
And they might even inquire about government subsidies available to small businesses in their industry.
All relevant concerns for a business owner in today's economy. Now let's wrap up with a few final terms.
Okay, so yield is the return on an investment, often expressed as a percentage.
A quote is an estimated price for a product or service.
Collateral is an asset that you pledge to a lender as security for a loan.
Depreciation is the decrease in the value of an asset over time.
Foreclosure is when a lender takes possession of a property because the borrower failed to make their mortgage payments.
And liquidity is how easily you can convert an asset into cash without losing value.
So imagine a business owner talking to their banker about getting a loan.
They might ask for a quote on the interest rate for the loan.
They might discuss what assets they can offer as collateral.
They might talk about the expected yield from a new investment they're considering.
And the banker would likely assess the business's liquidity to determine their ability to repay the loan.
Makes sense. Now, a couple more. Overhead refers to the ongoing expenses of running a business.
Like rent, utilities, salaries, the costs that are always there.
Principal is the original amount of a loan or investment, separate from the interest.
A rebate is a partial refund you get after making a purchase.
A shareholder is someone who owns shares of stock in a company.
And a tariff is a tax on imported or exported goods.
So picture an entrepreneur discussing their finances with their accountant.
They might brainstorm ways to reduce their overhead costs.
They might review the principal balance on their loans.
They might consider offering rebates to attract customers.
If they're thinking about going public, they'd discuss the implications of having shareholders.
And if their business involves international trade, they'd need to understand how tariffs might affect their costs.
Well, I think we've covered a pretty comprehensive list of financial terms. We've gone from the very basics of money all the way to complex business concepts.
Yeah, we've really hit a lot of ground today.
Hopefully by now, our listeners have a much clearer understanding of these terms and how they apply to their lives. Remember, even if you're not a financial expert, having a basic grasp of this vocabulary can make you a more informed consumer and a better money manager.
Absolutely. It's about empowerment. The more you know, the better decisions you can make about your own finances.
And as our financial world keeps evolving, staying informed is more important than ever. So keep learning, keep asking questions, and keep exploring.
Great advice. And remember, there are tons of resources available to help you along the way.
Exactly. So thanks for joining us today on Everyday English Pod. We'll be back soon with another deep dive into a fascinating topic. Until then, stay curious and keep those financial wheels turning.
See you next time.